Thank you, Evan, for that introduction. My name is Heather Evans, and I'll be going over the financial management. The first thing that I'll be discussing is potential risks and our solutions that we've came up with. The first risk would be reluctance to switch current bookkeeping providers. The second would be unauthorized access to private clients' information. And the third would be establishing credibility in our community. The solutions that we came up with that would be to emphasize what ASB has to offer our current providers, that we will be able to go beyond what the big bookkeeping services can do, that we could have a personal touch on it, that we can be there to make it exactly what they want. The second part would be to pay for firewalls and security system and have a clean desk policy. Some of you might not know what a clean desk policy is. That would be making sure that all clients' information is locked up and put away when we're not using it, that it cannot fall into the wrong hands. And then our third solution would be personal references and letters of recommendations from others. Financial information. One of the ways that we're going to try to get revenue is to keep our costs low for the first year. We plan on doing that by buying used furniture. Our partners will not withdraw from the assets for the first 3 years, and we do not plan on hiring any employees for the first year. Right here you will see our potential cash flow statement for year one. This is January through June. And then this is July through December. You'll see that our cash flow is negative the majority of the time until we get to December. The reason for this is because we believe we'll be spending a lot of our first year just trying to bring in new clients, not necessarily upselling and trying to get them to get the higher packages. And then this is our cash flow for year 1 and 3. So the first year you see that we have lost $43,000. And then the next year the loss in cash is only $18,000. And then the next year we plan on gaining more than enough money back that we had lost. So here is our balance sheet for the first year. You'll see one of the things that you might notice is that the owner's equity is only almost $15,000, even though we had it personally invested $20,000 a piece. The next year that will drop down to only $4,000. But through networking, through bringing in new clients, and just selling our new company, by the third year, we will now have more equity than what we originally put into it, which will be $26,000. If you look in the business plan paper that we provided, you will notice that the income statement is missing. So I'd like for you to take a good look at it now. And the first year you'll see that we will lose $21,000. But most businesses do take a loss their first year. And then you'll see on the second year we will make $5,000. But by the time we get to year 3 and we have built up our client base, we will have made almost $85,000, which will be pretty good. Our funding request. Each partner will be contributing $20,000 at the beginning, making that a total $100,000. And then we plan on getting a bank loan for $100,000, making our startup cash $20,000. Our return on investment the first year will be negative 21%. The second year will be negative almost 6%, but then the third year it will be at 85%. Next up is Cali with operation and management.